Warren Buffett is famous for the way he not only survives market crashes, but profits from them.
The best thing that can happen from Berkshire's standpoint is to have markets that go down a tremendous amount.
We'll show you the strategy that he employed before the 2000 collapse, the 2007 financial crisis, and importantly, what he's doing today. Leading up until 2000, there was a storm brewing. When an online toy company that's losing money sells for a PE ratio over 1,000, something is wrong. The market was in a bubble, and we all know this period as the Dotcom collapse. So what was Warren Buffett doing before this crash here? We have that information. And some people might ask, Cooper, how did you get this information? That answer is easy. I gave Buffett a call and he told me. No, all of his past reports are on his website. You can read them, and if you go to the balance sheet segment, it literally shows you exactly where he put his money, ranging from the cash he had, to the amount that he had in stocks, to what he owned in fully acquired businesses. How did he prepare in a stock market bubble?
If you read financial history for a couple of 100 years and take the South Sea bubble and the tulip boom and some of the panics we've had in this country, we closed the stock exchange for a few months back around 1914. Anything can happen. And you ought to conduct your affairs so that if the most extraordinary events happen, that you're still around to play the next day.
Let's break it down simply. In 1998, as the bubble was brewing, he had $36.8 billion in wholly owned businesses. From a portfolio perspective, that made up 40.1% in these businesses that he'd acquired throughout his life. These include the likes of Nebraska Furniture Mart, the famous furniture store started by Mrs. B, or GEICO, the insurance company, or See's Candy, the sweet company. These are different to stocks because they are not publicly available businesses for anyone to buy. They are privately owned. In this case, they're owned by Warren Buffett, and Buffett, he likes to hold these businesses for life. The next part to his asset allocation was $13.5 billion in cash and cash equivalents. Remember that cash equivalents for Buffett generally mean short-term treasury bills. From a portfolio perspective, that is 15% in cash, and this is what he was saying about it at the time.
There are times when we're awash in cash, and there have been plenty of times when we didn't have enough cash. We obviously are looking every day for ways to deploy cash, and we would never have cash around just to have cash. I mean, we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something and we have more cash around than we would like. And in recent years, we've tended to be cash heavy, but not because we wanted cash per se.
Buffett never likes to hold cash, but sometimes there are periods where you simply don't have a choice. There are no other options, because generally, he would actually like to have his cash in this asset class here. Leading up until the dot-com crash, he had $39.7 billion in equity securities. This would make up about 44% of his portfolio in equities, aka stocks. Stocks, equity, and securities all mean the same thing. But these stocks back then were very different to what he has today. I couldn't find the exact stocks that he owned at the time, but I did find an article that showed his 10 largest holdings that he owned 6 years earlier. Coca-Cola was number 1 at $3.9 billion, GEICO was second at $2.2 billion, ABC was $1.5 billion, the Gillette Company $1.3 billion, then you've got Freddie Mac, Wells Fargo, and General Dynamics, the Washington Post, and Guinness to round up the top 10. These are all businesses, aka Warren Buffett's favorite asset class.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are.
And so this was his portfolio back then, leading into the massive dot-com collapse. To be honest, I thought that he might have had more cash. He was being quite aggressive in the amount of stocks that he owned and the amount of businesses he owned, except he was not buying all of the stocks that most people wanted to own. Essentially, he was doing the opposite. He bought General RE for $22 billion in December 1998. This was Berkshire's largest acquisition in its history at that point in time. That same year, he bought NetJets, who were struggling with debt, and Buffett picked them up for a cheap price, relatively speaking. The next year, he bought Mid-American Energy, which he paid $2 billion for. He was being very aggressive, which is a different approach to what he's doing now. Before we get into his strategy today, let me show you how he prepared back in 07.
You can imagine the American economy is an economic train moving down a track that has no ending. And it picks up cargo and passengers as we go along. There's 330 million of us now, and there were only 4 million in 1790. And Our farms are incredibly more productive, and we have 75 million houses, and we had a few huts then, and we have great universities and all of these things. So we're just constantly moving more and more cargo and passengers along. And occasionally that train is going to get derailed.
In 2008, the train that we call the American economy was about to get derailed in one of the most extreme cases that we have seen since the Great Depression. Let's look at what Buffett did before the crisis hit, and importantly, what he did during the crisis. In early 2006, he did an interview with Charlie Rose in which he was not complaining, but saying he can't find any deals.
And when I look at the deals that have been made in the last year, there's not one I'm envious of. So, I mean, it isn't like we missed them. You know, it may turn out that I should have bought one of them, but I mean, there's none that I feel, gee, I wish I'd bought that last year. But I hope I buy one tomorrow.
It just so happened that Warren Buffett's wish was to come true, because some deals would come his way later that year, and Warren Buffett gleefully signed the check.
The last time we talked about the rise of Berkshire Hathaway, you were sitting on, give or take, $1 billion, about $44 billion. Mm-hmm. You didn't find anything that you were very interested in making an investment. Since then, you've made some investments.
Yeah, we've spent over $10 billion this year. One was ISCAR, which was $4 billion, 80% we bought of a $5 billion business. Pacific Corp was $5 and a fraction billion, and we're finding a few things.
If you think of Warren Buffett like a chess player, people like to believe that he's a very conservative tactician. The truth is, he plays the game quite aggressively. He's always looking to attack the opponent, so to speak. He's always looking to buy stocks, to deploy his cash and deliver that checkmate no matter what the market's doing. Leading into the financial crisis, his portfolio was valued around $167 billion, and this is how it looked. Cash was his smallest position at 22% of the portfolio, with $37 billion sitting in cash and cash equivalents. The next largest position was his wholly owned businesses. This was worth $55 billion, or 32% of the portfolio. By this time, he had accumulated the likes of Nebraska Furniture Mart, American Energy, Buffalo News, ISCAR, to the wholly owned businesses side of his portfolio, and a bunch more. And then stocks were the largest asset class, valued at $75 billion, or 44% of the portfolio. And back in 2007, the stocks he owned looked like this. His largest position in terms of market value was the Coca-Cola company, valued at $12 billion. He bought all of these shares for $1.2 billion. Cheeky 10x. The next largest position was Wells Fargo at $9.1 billion, then American Express at $7.8 billion, Procter & Gamble at $7.4 billion, and if you want to see the rest of the stocks he owned at the time leading into the financial crisis, feel free to pause the video and check them out, but very different to the stocks that he owns today. So that was before the crash, but what about in the crash, and what about after the crash? As the market was crashing, Buffett used a technique which I like to call the Buffett bucket technique. It's based around a simple principle. When it's raining gold, hold out a bucket, not a thimble. He deployed his huge cash pile into businesses. In late 2008, he bought $5 billion worth of Goldman Sachs preferred stock, which provided him with a steady stream of dividends at low risk. He then put $3 billion into General Electric, which at the time was facing a lot of challenges. Again, he bought preferred shares as opposed to ordinary ones, which offered a nice 10% annual dividend. He consistently bought shares of Wells Fargo in and after the crisis. Buffett had already been a shareholder of this bank before the crash, but when it occurred, he significantly upped his stake.
It's a wonderful bank, and it's going to do very well over time.
During the crash period, he also invested into IBM, Mars, Kraft Heinz, and completed his acquisition of Burlington Northern Santa Fe in a deal valued at $44 billion. Even for Buffett, that's a lot. As most people were panicking, Warren Buffett was snapping up stocks.
The best thing that can happen from Berkshire's standpoint is to have markets that go down a tremendous amount. If the market gets cheaper, we will have many more opportunities to do intelligent things with money. We're going to be buying things for as long as I live, just like I'm going to be buying groceries. Would I rather have grocery prices go up or down if I'm going to be buying groceries tomorrow and next week and next month and next year? The answer is obviously I will do better if prices are lower.
A simple strategy, but hard to implement in the throes of panic. Could you buy while everyone else sells? There's no doubt that during the next crash, Warren Buffett will do the same as what he did back then and accumulate. But how is he preparing for a crash today? Because his strategy right now is a little different to what he did in the past. After all, this is a world dealing with issues like potential tariff volatility and trillion-dollar AI crashes, all while data suggests that the S&P 500 is the most concentrated it's been in history. In fact, BlackRock, Vanguard, Goldman, and JP Morgan all predict the S&P may fall short of its typical 9% annual return. So what are other wealthy Americans doing? Last year, Bank of America surveyed wealthy individuals, and among high net worth respondents, 43 and younger, over 80% say they currently own art for investment purposes or would like to. Why art? Well, after weathering multiple recessions, newer generations said they want to diversify beyond just stocks and bonds for a slice of their portfolio. In addition, a 2023 study by Deloitte estimated the overall art and collectibles wealth was at nearly 2.2 trillion and projects it could hit almost 2.9 trillion in 2026, leaving room for potential upside. That's why you should check the sponsor of today's video, Masterworks. While the sector looks to keep expanding, you don't need to be a billionaire or an arts expert, and Masterworks has already distributed back a total of over $60 million, including principal in investor proceeds across their 23 exits. Masterworks art investing platform features blue chip artwork offerings for investors in the form of shares, with previous offerings including legendary artists like Picasso, Basquiat, and Banksy. Masterworks has passed $1 billion in investor capital across their 450 offerings. So popular offerings have the potential to sell out rather quickly. But if you want priority access, you can use the QR code on the screen now, or click the link in the description, or go to masterworks.art/Cooper Academy. Okay, now let's see what Buffett's plan is for today. Before we get into Buffett's exact asset allocation between cash, stocks, and wholly owned businesses, let's talk about what he's doing. First, as we all know, he sold large positions of his Apple stock, Bank of America stock, and other positions. But when it comes to stock buys, he's not doing much at all, and the stocks that he is buying are all just minuscule investments. They're so small that there's a good chance it's not even Warren Buffett making these moves, but the investors under him, Ted or Todd.
It isn't like I've got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
I love it how Warren Buffett's version of a hunger strike is not buying any stocks. To him, not buying stock is almost as bad as not eating. That's how much he likes investing. And when he mentioned the ways that this strategy could change for him, the only thing that I can think of that can change for Buffett to alter what he's doing is for the prices of stocks to get cheaper, aka stocks to crash. It's either that or a big elephant of a company comes along and offers to sell itself to Buffett at a reasonable price. Kind of like what happened with BNSF Railway 15 years ago. But in these market conditions, somehow I don't see that happening, which means his portfolio right now will stay similar to what it's like right now. His smallest position at 24% of his portfolio, worth $188 billion, is the fully acquired businesses that he's bought over the years: GEICO, Duracell, BNSF Railway, NetJets, Dairy Queen, etc, etc. Then we've got his stock positions valued at $271 million, worth 35% of the portfolio. So these are his stocks right here. Apple is still his largest position at 26%, despite the large selling. American Express is the second at 15%, Bank of America at 13%, Coca-Cola at 11%, Chevron at 6%, Occidental at 5%, Moody's at 4%, and Kraft Heinz, Chubb, and DaVita to round off the top 10. Those are his stocks, but stocks, much to many people's surprise, are not his largest position. His largest position is the asset that he's always said that he doesn't like holding a lot of, which is cash. He has $320 billion of cash, which makes up 41% of the portfolio. If Buffett doesn't start buying anything soon, this could end up being half of his entire portfolio.
But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive.
He could deploy this money into Nvidia, like so many of the index funds are doing. He could put it into Amazon or Microsoft or Tesla, like the regular investor is doing. But Buffett is not a regular investor, and his strategy is a completely different one.